When is the right time to buy? This is the single most important and most difficult question an investor or speculator will ever face. The financial markets are littered with the wreckage of accounts that were destroyed by answering this question incorrectly. To buy too early during the heart of a brutal bear market is to catch a falling knife, an act that leads to devastating and demoralizing losses. To buy too late during the euphoric peak of a bull market is to become the bag holder, the final hopeful buyer who is left with worthless shares after the inevitable collapse. For the amateur, the decision of when to buy is a guess, an act of hope, or an emotional reaction to a news headline. But for the professional operator, it is a science. It is a process of waiting, of observing, and of identifying the precise moment when the balance of power in the market has invisibly but decisively shifted. No one in the history of market analysis dedicated more effort to codifying this moment than Richard Wyckoff. He was a master detective of Wall Street, a man who spent his life studying the actions of the market's great operators to create a universal framework for understanding their campaigns. He did not offer a simple indicator or a magic formula. He offered a complete logical schematic for identifying the process of a market bottom, a detailed blueprint he called the accumulation phase. This is not just a pattern. It is a story of the methodical transfer of stock from the fearful and uninformed, weak hands to the patient and knowledgeable, strong hands. To understand this process is to answer the great question of when to buy. In this deep dive, we will deconstruct the complete anatomy of a Wyckoff accumulation campaign, exploring each of its phases and key events, providing a timeless guide to identifying the point of maximum opportunity. Before we can dissect the intricate phases of the Wyckoff schematic, we must first establish the foundational law upon which his entire philosophy is built: the universal law of supply and demand. For Wyckoff, this was the alpha and the omega, the beginning and the end of all market analysis. He understood that the price of any security in any market at any time moves for one and only one reason: a change in the relationship between the supply of shares available for sale and the demand for those shares from buyers. Every other factor, company earnings, economic data, news headlines, geopolitical events, is secondary. These factors are merely catalysts that can influence the decisions of buyers and sellers, but they are not in themselves the cause of price movement. This is a profound and critical distinction that separates the professional Wyckoff analyst from the amateur. The amateur sees a positive news story and buys, assuming the stock must go up. The professional understands that the news is irrelevant until its effect on the balance of supply and demand can be observed on the ticker tape. For example, a company may release a spectacular earnings report. The amateur sees this good news and immediately buys the stock, only to be baffled when the price falls. The Wyckoff analyst, however, is watching the price and volume action. They might see that on the day of the announcement the stock opened higher, but then closed lower on massive volume. They would interpret this action as a clear sign that the large, informed operators, the smart money, had anticipated the good news and were using the public's excitement as a perfect opportunity to unload or distribute their large holdings. The huge volume represented a massive increase in supply which overwhelmed the public's demand, causing the price to fall. The market's action revealed the true story while the news created a false narrative. The only place where this real-time battle between supply and demand is recorded with perfect, unbiased fidelity is through the price and volume data on the ticker tape. Wyckoff's entire life's work was dedicated to teaching traders how to read this tape, to ignore the distracting noise of news and opinion, and to focus solely on the objective evidence of the market's own actions. His accumulation schematic is the ultimate tool for this purpose. It is a visual guide to interpreting the shifting balance of supply and demand at a major market bottom. The Wyckoff model of accumulation is a detailed, multi-phase process through which large, informed interests, collectively known as the composite man, absorb a large quantity of stock after a major downtrend. This process creates a cause which will lead to the effect of a new uptrend. The entire campaign typically unfolds within a trading range, or TR, a period of sideways price action where the previous downtrend has been halted. Let us now deconstruct the anatomy of this process, phase by phase. Phase A, stopping the downtrend. The very first stage of a new bull market is the cessation of the previous bear market. This does not happen suddenly. It is a process that is often violent and dramatic. Phase A is characterized by the final exhaustion of the overwhelming selling pressure that defined the preceding downtrend. It is here that the first clear evidence of large-scale buying begins to emerge. Wyckoff identified several key events within this phase. The first is preliminary support, or PS. After a prolonged decline, a point is reached where the selling is met with the first significant wave of buying. This is visible on the chart as a day or week with a noticeable increase in volume and a widening of the price spread. This buying is not yet strong enough to stop the downtrend, but it is a signal that the large, value-oriented institutions are beginning to test the waters, recognizing that prices are becoming attractive. The downtrend typically continues, often with renewed force, until it reaches the most dramatic and important event of the entire accumulation phase, the selling climax, or SC. This is the moment of maximum pessimism, the point of absolute public capitulation. The news is universally terrible, and the public, having endured months of painful losses, finally gives up all hope. They sell their holdings in a state of pure panic, desperate to exit the market at any price. This wave of panicked selling is reflected on the chart as a day of extremely wide price spread, where the stock plunges to a new low and a massive climactic spike in trading volume. It is at this precise moment of maximum fear that the composite man, the strong-handed professional operators, steps into the market with immense force. They aggressively absorb the massive supply of shares being dumped by the weak hands. The visual evidence of this is profound. Despite the huge volume and the sharp move down, the price often reverses and closes well off its lows for the day. This is the first clear, unambiguous evidence that a major transfer of ownership from the fearful to the confident is taking place. Following the selling climax, the intense selling pressure is temporarily exhausted. This creates a vacuum of supply which allows the price to rebound sharply, often with very little buying pressure. This is the automatic rally, or AR. This rally is a technical event driven more by the absence of sellers than the presence of aggressive buyers. The height of the automatic rally is extremely significant because its peak will often define the upper boundary or the resistance of the new trading range. After the automatic rally, the market will typically drift back down to retest the price area of the selling climax. This is the secondary test, or ST. The character of this test is critically important. A successful secondary test will occur on much lower volume than the selling climax. This is the analyst's first strong confirmation that the selling pressure has indeed been exhausted. The panic is over. The fact that the market can revisit its extreme lows without provoking another wave of panic selling is a clear sign that the supply has been absorbed. At the conclusion of Phase A, the downtrend has been definitively halted, and the boundaries of a new trading range have been established between the low of the selling climax and the high of the automatic rally. Phase B, building the cause. This is typically the longest and most psychologically frustrating part of the entire accumulation process. Wyckoff termed this building the cause. During this phase, the stock trades sideways within the established range, often for a very long time, with no clear direction. This phase is characterized by a general dullness in price action and relatively low and often diminishing volume. It is during this period that the composite man does the majority of his work. He methodically and patiently absorbs the remaining floating supply of the stock from the public. He will buy on weakness near the bottom of the range and may sell small amounts on rallies near the top of the range. This selling serves two purposes. First, it allows him to profit from the short-term swings, and second, it serves as a test of the remaining supply. By selling into a rally, he can gauge how much selling pressure still exists from the public. For the average investor, this phase is a period of immense frustration. The stock seems to be going nowhere. It is dead money. This lengthy period of sideways action is what causes the final remnants of public interest to wane, and they will often sell their shares out of sheer boredom and impatience. This is exactly what the composite man wants. He is using time to his advantage, quietly accumulating his massive position without alerting the public or creating the kind of excitement that would drive the price up prematurely. For the Wyckoff analyst, while this phase may be boring, it is the most important part of the process. It is the period where the cause, the accumulation of a large position by informed operators, is being built. According to Wyckoff's law of cause and effect, the longer and more extensive this cause-building phase is, the more powerful the eventual effect, the subsequent markup in price, is likely to be. This level of detailed patient analysis is the hallmark of a professional operator. It requires a deep and dedicated study of these nuanced principles, an understanding that the market has a hidden logic that can only be seen by those who know how to look. Recognizing this, we have created a new dedicated resource for the serious student of this method. Wyckoff was not just another trader on Wall Street. He was the first to systematize the hidden logic of the market. It was he who explained how supply and demand create the repeating cycles of accumulation and distribution that are still in effect today. To explore these principles more deeply and to go step by step through the market phases and rules of Wyckoff, we have created a separate channel, Richard Wyckoff Trading Methods. We invite you to subscribe. A link is in the description. Phase C, the final test. After the long process of absorbing supply in Phase B, the composite man must conduct one final test to ensure that the market is truly ready for a major advance. He must be certain that the majority of the floating supply has been absorbed and that there are no significant sellers left who could disrupt the coming uptrend. This test often takes the form of a decisive and highly deceptive event known as the spring, or a shakeout. The spring is a masterful act of manipulation, a sharp price move designed to mislead and trap the last remaining uninformed market participants. It is a price move below the established support level of the trading range. This deliberate break of support is designed to accomplish three things simultaneously. First, it creates the powerful visual impression that the prior downtrend is resuming. This induces the last of the fearful longholders to finally throw in the towel and sell their shares in a panic. Second, it triggers the protective stop-loss orders that disciplined traders may have placed just below the support of the range. Third, it entices aggressive short sellers or bears to enter the market believing they are capitalizing on a new validated breakdown. This maneuver creates a final, artificial wave of selling from the weak hands. The composite man then uses this artificially created liquidity to absorb the last available shares at the most advantageous prices possible. The definitive characteristic of a true spring, the one that distinguishes it from a genuine breakdown, is what happens next. The price does not continue to fall. Instead, it quickly and decisively reverses and closes back inside the trading range. This rapid reversal, often on increased volume, is the ultimate confirmation that the supply of shares below the support level was minimal, and that the move was a deliberate maneuver to clean out the last of the sellers. The market has been tested for supply, and the test was successful. The path of least resistance is now upward. Phases D and E, the confirmation and the markup. Phase D marks the beginning of the new uptrend, the period where the stock finally moves out of its long consolidation. This phase is characterized by a clear and sustained dominance of demand over supply. The stock begins to rally on widening price spreads and increasing volume. A key event in this phase is the jump across the creek, or JAC, which is a decisive move above the resistance line of the trading range. The creek is the line of resistance that has capped all the rallies during the long consolidation. The JAC is the first major sign of strength, or SOS, a clear indication that the buyers are now in full control. Following this initial breakout, the market will often experience one or more low-volume pullbacks to test the old resistance level, which has now become new support. This pullback is called the last point of support, or LPS, or a backup to the edge of the creek, BU. This is the final low-risk opportunity to initiate a long position. The stock has proven its strength by breaking out, and it has confirmed that supply is exhausted by pulling back on light volume. This is the moment the Wyckoff analyst, who has patiently watched the entire accumulation process unfold, finally acts. Phase E is the final phase, where the new primary uptrend is clearly established and begins to attract the attention of the general public. The stock moves decisively higher, fueled by improving business fundamentals and growing public optimism. The composite man's campaign of accumulation is complete, and the public now begins to participate, driving the price to new highs. We have now completed the exhaustive blueprint for identifying a market bottom and answering the great question of when to buy. But every bull market that is born from accumulation must eventually die in a process that is just as methodical, just as psychological, and just as important for the investor to understand. That process is distribution, the art of selling, and it is the subject of our continuation. That process of methodical selling at a market top, the mirror image of the quiet campaign of buying that precedes it, is what Richard Wyckoff termed distribution. It is the art of selling, and understanding its anatomy is the definitive answer to the second great question every market participant must face. When is the right time to sell? While accumulation is a story of stealth and patience, distribution is a story of cunning and deception. It is the phase during which the composite man, the large informed operators who patiently accumulated their positions at the bottom, methodically unloads those same shares onto an eager, euphoric, and ultimately unsuspecting public at the top. This process is not a single event. It is a prolonged and deliberate campaign that unfolds over weeks and months, creating a volatile and confusing trading range that is designed to mask the true intentions of the smart money. By deconstructing the schematic of this campaign, we can learn to recognize the subtle but clear warning signs of a major market top, and in doing so, learn how to protect our capital and our profits from the inevitable decline that follows. The Wyckoff model of distribution is a detailed, multi-phase process that begins when a powerful and established uptrend is nearing its conclusion. The public, having witnessed months or even years of rising prices, is now in a state of maximum optimism. The news is universally positive, stories of easy profits abound, and the fear of missing out has completely replaced any rational sense of risk. This environment of rampant greed is the ideal selling ground for the composite man, who can now feed his massive inventory of shares into this wave of insatiable demand without causing the price to collapse. The entire distribution phase is a grand transfer of ownership from the strong, informed hands back into the weak, emotional hands at the highest possible prices. Phase A, stopping the uptrend. Just as in accumulation, the first phase of distribution is the process of halting the prior trend. In this case, the powerful markup phase, or uptrend, begins to lose its momentum as the first significant wave of large-scale selling or supply enters the market. The first sign of this is often preliminary supply, or PSY. After a prolonged advance, a day or week will appear with a sharp rally on noticeably increased volume. This is often the first point at which the early, most astute professional operators begin to take profits. This initial selling is not yet strong enough to stop the uptrend, which often continues to one final climactic peak. This peak is the buying climax, or BC. It is the mirror image of the selling climax and represents the point of maximum public euphoria and participation. The price often surges upward on a very wide spread, accompanied by the highest, most climactic trading volume seen during the entire uptrend. This is the moment when the last of the amateur buyers, terrified of being left behind, stampede into the stock. They are buying with pure emotion, convinced that the trend is limitless. The composite man uses this massive wave of public demand as the perfect opportunity to unload a significant portion of his holdings. The telltale sign of a buying climax is what happens to the price. Despite the enormous volume, the price makes little or no further upward progress and often reverses to close well off its highs for the day. This is the ultimate sign of effort versus result. A massive amount of buying effort has failed to produce a corresponding result in price because it was met with an even more massive hidden wave of institutional supply. Following the buying climax, the intense buying pressure is temporarily exhausted. This creates a vacuum of demand, which allows the price to fall sharply. This decline is known as the automatic reaction, or AR. The force of this decline is often a shock to the euphoric public, providing the first real evidence that the market is no longer a one-way street. The low point of the automatic reaction is extremely significant, as it often defines the lower boundary or the support of the new distribution trading range. After this sharp drop, the market will typically have a reflexive rally back toward the area of the buying climax. This is the secondary test, or ST. A successful secondary test of the high will occur on noticeably lower volume than the buying climax. This diminished volume is a critical bearish sign. It indicates that the powerful, aggressive buying demand that characterized the uptrend is beginning to wane. The market has attempted to rally back to its old highs, but the effort was unenthusiastic. At the conclusion of Phase A, the powerful uptrend has been definitively halted, and the boundaries of a new, volatile trading range have been established between the high of the BC and the low of the AR. Phase B, the zone of distribution. This is the phase where the composite man does the majority of his selling. After stopping the advance in Phase A, he now has a well-defined price range within which to methodically distribute his remaining inventory of stock. The stock will trade sideways in a volatile, choppy fashion, often for a very long time. During this phase, the composite man acts as a master manipulator of sentiment. He will sell his shares into the rallies, or upthrusts, that test the resistance at the top of the range. This selling to the eager buyers who are trying to buy the dip is the primary activity of this phase. He may also at times support the price on declines toward the bottom of the range, buying small amounts to prevent a premature breakdown. This creates a confusing two-sided market that churns through a great deal of volume but makes no sustained upward progress. For the public, this phase is a trap. The apparent strength on the rallies keeps their hopes alive, while the declines are not yet severe enough to cause widespread panic. They are slowly being lulled into a false sense of security, while the smart money is quietly heading for the exits. For the Wyckoff analyst, this extended period of high-volume churning with no net price gain is a massive red flag. It is the clear, unmistakable footprint of institutional distribution. It is the cause being built for the subsequent markdown or downtrend. Phase C, the final deception. Phase C often contains the final act of deception before the markdown begins. This is the composite man's last and often most brilliant maneuver to mislead the public and to sell his last remaining shares at the highest possible prices. This climactic event is known as an upthrust after distribution, or UTAD. The UTAD is the mirror image of the spring. It is a sharp and often surprising price move above the established resistance level of the trading range. This breakout to a new high is the ultimate bull trap. This move is designed to do three things. First, it triggers the buy-stop orders of technical traders who have placed them just above the resistance line, anticipating a resumption of the uptrend. Second, it creates a final wave of FOMO, or fear of missing out, among the public. They see the stock making a new high and believe the long consolidation is finally over, and they rush to buy, terrified of missing the next great leg up. Third, it forces the early aggressive short sellers who were betting on a decline to cover their positions at a loss, adding more fuel to the buying pressure. The composite man uses this final artificially created burst of demand as the perfect opportunity to distribute his last remaining inventory of stock to this maximally optimistic group of buyers. The definitive characteristic of a UTAD, the one that distinguishes it from a genuine breakout, is that it fails to hold. The price is unable to sustain its move into new high ground. It is met with a massive, overwhelming wave of supply from the composite man. The price will quickly reverse and fall back into the old trading range, often on a wide price spread and a surge in volume. This failure is the ultimate confirmation that the market is in the hands of the sellers. The test of the market's strength has failed. The final group of bulls has been trapped, and the path of least resistance is now decisively downward. Phases D and E, the confirmation of weakness and the markdown. Phase D marks the beginning of the new primary downtrend. After the deceptive UTAD, the stock now shows a clear and sustained dominance of supply over demand. A key event in this phase is a decisive break below the support line of the trading range. This is known as a major sign of weakness, or SOW. This breakdown, especially if it occurs on expanding volume, is the first clear evidence that the long period of distribution is over and that the sellers are now in complete control. Following this initial breakdown, the market will often experience a final, weak rally on low volume that travels back up to the old support level, which has now become a new level of resistance. This is known as the last point of supply, or LPSY. This is the final, high-probability opportunity for a disciplined operator to initiate a short position. The rally's failure at the old support level, confirmed by its anemic volume, is the market's final signal that all buying power is exhausted and a major decline is imminent. Phase E is the final phase of the cycle, the markdown. The new downtrend is now clearly established. The public, who bought with euphoria in Phase C, now begins to sell in a state of growing panic. The selling feeds on itself, and the markdown phase accelerates to the downside, often retracing the entire prior advance. The composite man's campaign is complete. He has successfully transferred his entire holding to the weak hands at the top, and he may now even be on the short side, profiting from the decline he helped to engineer. The enduring legacy of Richard Wyckoff is that he provided a logical and coherent framework for interpreting the raw data of the market. He was not an inventor of a magical black box indicator. He was a master observer and a brilliant educator who systematized the timeless principles of the market's behavior. His work teaches traders to stop forecasting and to start analyzing, to stop guessing and to start reading the objective evidence presented by the tape. The Wyckoff Method provides a way to understand the market not as a series of random events, but as a series of logical, repeating campaigns orchestrated by informed professional interests. It is a complete roadmap that provides a clear answer to the two great questions of the market. It tells you when to consider buying at the conclusion of a successful accumulation, and it tells you when to consider selling at the conclusion of a successful distribution. By learning to decode this structure, the individual investor can begin to think and act in harmony with the smart money, rather than perpetually being its victim. Before we conclude, we want to extend our gratitude to you, our viewers. We put an immense amount of research and effort into creating these deep dives, and your engagement is what makes it all possible. To everyone who watches, who subscribes, and who takes the time to leave a thoughtful comment, thank you. Your participation is what helps these videos reach a wider audience on YouTube. A special thanks is due to those of you who have supported the channel through the Super Thanks feature. Your direct support is a powerful motivator for us to continue this work and to keep raising the bar on the quality of our analysis. What we today call the Wyckoff Method was born not in textbooks, but on the real, brutally competitive Wall Street of the early 20th century. It was from these direct observations that he wrote his foundational works. Max Davidson has made one of Wyckoff's most important texts, How I Trade and Invest in Stocks and Bonds, accessible for the modern reader, adapting the language and explaining the historical events, names and terms that can seem distant. The result is an edition that allows you to experience Wyckoff's original thought process without the barrier of archaic language or the need for constant reference material. If you wish to go deeper than is possible in a video format, we recommend you explore this book. The link is in the description.